When it comes to the investment journey, there's a couple milestones. And the first one, of course, is hitting that six-figure, that $100,000 mark, which is what we're going to be covering today in my portfolio. We are just north of $100,000 in there. I'm going to show you the composition in the breakdown that we've been seeing in here. Now, when it comes to investing, there is nothing super impressive or flashy about it. It is about consistently putting money into the market and really letting the money work. You're not going to time the market. There's no really perfect time to buy, but ultimately the number of years that you're in the market is going to make the biggest difference. Now, when you look at Warren Buffett, once he hit the age of 60, you started really seeing the compounding interest and the snowball effect that you see with the portfolio as well. So let's go ahead and take a look at my portfolio itself. So looking at this is from M1 Finance, and I have a link right down below. Zoomed in a little, you can see our debt-free journey. We are at 101,012. That is right, $101,000. So over the last week, had a really spectacular week, which we'll break down very shortly. But looking at this, the buying power, 1,047.13. So again, we're continuing to put $1,000 in there every single week, which I believe at this point, we're 20 weeks in, meaning that we've actually put $20,000 into this portfolio. So looking at this and kind of breaking it down mathematically, I know a majority of investors are not going to have this amount to put in there. But even if you think about a same portfolio where, let's say you're putting $100 in there every single week or every single month, it is going to make a big difference. Now, of course, it's not going to grow as fast, as quick, but overall, the power of the compounding interest and also the growth of the market is going to make a big difference. Now, you can see right here, we have a 4 ETF portfolio. If you're familiar with any of the content that I put out on the finance channel, it is really this portfolio that works incredibly well. And honestly, it's pretty well diversified, which we'll go through in just a minute. But looking at the investing journey, so we actually started this right here, September 26th of 21. So we're about 2.5 years in. At that 2.5 year mark, we've already gotten $100,000. Now, overall, looking at kind of the breakdown from this, you can see ending net cash flow, we put in 84K. So we have seen a significant amount of growth going into 2022, 2023, and now moving into 2024. We have made a 65.54% return on this portfolio. That is right. In 2.5 years, we have grown this 65%, which I know is kind of crazy to think about, but yes, we actually have. Now, how did we do this? It was through dollar cost averaging. So remember back in 2022, if you rewind 2 years, the market was doing absolutely horrible. We were putting in money every single 2 weeks, and we were buying into the position that we hold today with these ETFs. And as we continued to buy more, the market continued to drop. We continued to buy more, the market continued to drop. We were buying these ETFs at a massive discount in 2022. Then you look at 2023, even in Q3 and Q4 of that year, the market had a massive rebound, and we've also seen the rebound kind of going on this year. Again, looking back year to date, we're at about an 8% growth rate, which is normal. That is still pretty good. But then when we start going back 12 months, it goes to a 33% weighted return, which of course is kind of crazy. And then when you go even further, we're at that 65 return. So what 4 ETFs do I recommend and do I hold in my personal portfolio? They are right here, guys. So you'll see there is a 25% split between all of these. Now, of course, the QQQM is the NASDAQ 100. So making sure that we have, and this is pretty tech heavy. When you look at some of their biggest holdings within the QQQM, you can see down here the breakout of common stocks. We have Microsoft, Nvidia, we have Meta, Google, Costco in there, Apple, Amazon, Broadcom, Alphabet, and Tesla. So even looking at the Magnificent Seven, we hold a big chunk in here. Now you'll notice with these portfolios, there is an overlap between them, but within the overlap itself, we do carry some of the heavier stocks. Some of them are more focused on the percentage-wise, which again, you'll kind of see in the portfolio, but I know there is an overlap, and I know that's something that I know a lot of you are kind of concerned about. But overall, even if you did a 3 ETF portfolio, you could kind of see the similar growth. So looking at the QQQM, that is holding 100. Now with the Vanguard Growth Fund, this one specifically is holding, I believe it's about 208 different companies. But again, you'll notice kind of the overlap with very similar in here. but there are some different names in here. And what you'll notice is the percentages really change. So I did a video with the VUG and the Vanguard growth funds, and overall the performance of the VUG compared to the other growth funds really is poised based on what they carry and how they hold it in the percentages that they carry it to do exceptionally well probably in the next 5 to 10 years. And we have seen explosive growth. Again, when you look at Microsoft and you look at NVIDIA, very, very big positive growth in there, especially with the heavy focus with the artificial intelligence and everything that is kind of building in there. So to add a little bit of diversification in here, we have this S&P 500. Now, of course, this one is the 500 largest companies in the United States, which means it is not broken into one sector at all. It is broken into a lot of sectors, but you'll see even when it comes to some of those, there is kind of the overlap in there. But you'll notice some of them are different. We have Berkshire Hathaway in here. Again, we have Eli Lilly, we have Broadcom, we do have, again, the Magnificent Seven because they are represented into a big part of these portfolios. And then the final one we look at is the SCHD. Now, I did a video on this as well. When it comes to the SCHD, we were comparing this into other dividend ETFs, and overall, the performance of this one has done incredibly well. Not only that, the dividends, we're earning some dividends in here, which we like to see. This one has a lot less volatility. However, the SCHD, you can see that over the day, it's went down quite a bit. When you start looking at the week or even the month, doing pretty well. Now, they also did a reallocation, so they changed up the holdings that they had within the SCHD. Definitely check that out because it's very interesting to see how they do change this up. You can see dividend yield 4.12. That is a massive dividend yield with a very, very low expense ratio. Now, all of the funds that I do carry have an exceptionally low expense ratio. But looking in here, again, when you think of diversification, most of these companies, even though I hold them in overlap with the S&P 500, because of the dividend yield that they have, Texas Instrument, Home Depot, Cisco, Pfizer, Chevron, UPS, BlackRock, PepsiCo, you can see a lot of different names in here. Because again, this is the large cap domestic, and this has a lot less volatility than we see with some of the other sectors. Now, again, I know there are some different ETFs that you could carry out there that you could hold, but really kind of breaking it up and segmenting it out, even looking at my Vanguard Growth Fund, we're at 70%, guys. That is right. We're at 70% in that Vanguard Growth ETF, which is incredible since we started tracking this, since we've really been focusing on this. Now, one thing to note is with M1, they do invest in pies. So you can see the target percentage on all these are 25. So based on the trade that we're doing, you'll see SCHD is much heavier weighted because it has been underperforming. So pretty much you are auto rebalancing your portfolio every time we do purchases, because even QQQM, since the cost of it or the value of it has increased incredible, we can see we're buying a lot more of specific ETFs within here, which are really cool. Now, you'll also notice that we have 4709 because we put 1,000 in here every week. Now, with that, of course, we do have the ability, the 4709 is dividends that we actually picked up from QQQM. The dividend payout for the VUG, the VOO, and the SCHD has not come in yet, but this week, the ex-dividend date, I believe for a majority of them, was March 22nd, which means all of those dividends are going to come in. And even there, guys, we've gained $1,100 in dividends, which is kind of crazy with a $17,000 market gain. I am excited to see this portfolio as we kind of continue with this. And then, of course, we do have our Excel spreadsheet. Let me go ahead and bring this over, guys, and we'll go ahead and expand this one. As you can see, we are 20 weeks in, and of course, let me slide this over. We are $20,000 invested. That's exactly where we're at. And you can see overall the net return at that 65%. Cash flow is almost 84, which means we've made $17,000 plus $1,100 in dividends, giving us the 101 portfolio balance in there. Now you can kind of see week to week, there have been a couple of weeks where we've actually seen negative, where it's kind of went down and again, kind of did some of the formations and formulas in here, but some of them have went down. We've seen some fluctuation. Now, of course, when they go on sale, and I say a sale kind of as a notation to you, is when stocks and when ETFs, when groups of stocks start seeing a negative cash flow or they start going negative with the returns, that is the time you want to be buying them. A lot of people say it's counterintuitive. When everything is going down, that's the time you need to be selling. Nope. When there's blood in the streets, you buy it all. Because again, with the stock market, it's going to recover. And it did in a very, very big way where everyone was selling and pulling out of the market in 2022. I was buying. And as a result, we have an absolute amazing ETF portfolio here. And again, with everything that we've invested, I mean, 84 invested, we're at 101, and we are literally 2.5 years. So once we tack on another 3 years, 5 years, 10 years, 20 years, depending on the point where we're going to get to retirement, because I want to run this and track this probably at least till we get our net cash flow at $100,000, which means that I personally invested $100,000 in seeing where that balance is. And then we might reconsider and see exactly what cryptocurrency is doing, because I do want a little bit of exposure. We were into the BlackRock or the Bitcoin ETF at a point. I don't like it personally just because I want to own the coins myself. I don't want them on an exchange. I don't want them on an ETF. And you'll also notice a lot of the ETFs are not actually tracking the price fluctuation that we see in Bitcoin. What I mean by that is Bitcoin might be up 10%. You'll look at your ETF might be up 7. That's because of the cost of the ETF itself, because there is management fees. There are a lot of other things that kind of go in conjunction with that, meaning you're not actually seeing the growth of Bitcoin yourself because you are holding it in that ETF. But all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think about the portfolio that we're running. If there's anything we need to change, I know a lot of people put comments down below when it comes to different ETFs and things that we should be invested in, but definitely willing to check out everything and really doing a comparison. As I learn and grow and figure out this investment journey, I'm doing the same exactly with you. So if you like the content, go ahead and subscribe to the channel, and I'll catch you in the next video.